ServiceNow just handed us the ultimate financial whodunit. Welcome to this explainer, where we're going to unpack the fundamental paradox of their incredible Q1 2026 earnings and the historic stock crash that literally happened right after. It is honestly one of the most fascinating case studies we've seen all year in how the market digests enterprise software valuations. We're going to look really closely at the data to understand exactly what happened, step by step, using the numbers straight from their earnings print and market analysis. Right off the bat, here's the multi-billion-dollar question. How does a company report a seemingly flawless quarter, beat every core metric, and immediately suffer its worst single-day stock drop in history? We are talking about a massive 17% plummet. Just to put that into perspective for you, that drop settled their market cap around $93 billion, completely wiping out roughly 41% of their year-to-date gains. To understand this, we really have to look past the headline success and dig into the mechanics of what the market was actually expecting. Because when you look at the actual numbers, Q1 was an absolute beat across the board. I mean, the business was humming. Subscription revenues hit a massive $3.67 billion. That's a 19% growth in constant currency. Their operating margins came in exceptionally strong at 32%, which actually beat their own guidance by 50 basis points. Plus, they generated $1.66 billion in free cash flow, representing a 44% margin. By literally every normal operational measure, management just completely nailed the execution for the quarter. So to solve this mystery, we first need to make sure we're on the same page about CRPO, or Current Remaining Performance Obligations. Think of CRPO as Wall Street's telescope for forecasting a software company's revenue over the next 12 months. It represents the total value of contracted future revenue that is officially locked in and expected to be recognized within a year. For a subscription software company like ServiceNow, analysts treat CRPO as the single most reliable leading indicator of forward growth. And here is where the disconnect becomes glaringly obvious. Since the Q1 CRPO actually beat guidance by a full 100 basis points, coming in at $12.64 billion, up 21% in constant currency, we really have to peel back those headline numbers to find the forward-looking trapdoors that triggered the massive sell-off. Q1 execution absolutely wasn't the problem. The problem was the signal for the rest of 2026. Basically, there were three distinct spooks that completely flipped the narrative. First, management guided Q2 CRPO growth to decelerate to 19.5% in constant currency, down from Q1's 21%. Second, they cut their full-year operating and free cash flow margin guidance. And third, the organic subscription revenue guide for the entire year was held completely flat. Let's break down exactly why these three factors combined to create such a violent market reaction. Starting with that revenue deceleration, management noted a 75 basis point headwind stemming from delayed deal timing in the Middle East. Geopolitical factors and macro uncertainty basically caused some large on-premise government contracts to get deferred. Now, while CFO Gina Mastantuono was careful to frame these as deferrals rather than lost deals, it presented a completely neutral macroeconomic challenge. It wasn't a flaw in their product, right? But rather outside forces that slightly tapped the brakes on their momentum, adding a little element of near-term risk. But the biggest culprit for the margin cuts, that would be their massive M&A activity. Just days before earnings on April 20th, ServiceNow closed a $7.75 billion all-cash acquisition of Armis Security. Strategically, this is a massive move. It broadens their security operations addressable market by roughly 3 times, effectively adding cybersecurity as a fourth major platform pillar alongside IT, HR, and customer service. But financially, well, it introduced some significant short-term friction. Integrating a giant like Armis directly drags down full-year operating margins by 75 basis points, dropping the guide to 31.5%. But even more significantly, it slashes free cash flow margins by a massive 200 basis points, lowering that guide to 35%. Management expects these to expand again by 2027 through internal AI efficiencies, but for a market that heavily prizes the immediate combination of growth and expanding margins, this guide down was structurally negative. Here is the real kicker. While the overall full-year subscription revenue guide was technically raised by about $200 million at the midpoint, that boost came entirely from the inorganic 125 basis point contribution of the Armis acquisition. The core organic business outlook was held completely flat. So for sell-side analysts, this meant that the amazing Q1 outperformance was merely absorbed into existing forecasts, rather than actually translating into any future upside. Now let's flip the script and look at the counter-evidence for the bull case, starting with an unprecedented mid-year raise of their AI revenue target. Despite the conservative, broader guidance we just talked about, ServiceNow raised their target for Now Assist, which is their suite of generative AI features, from $1 billion to a staggering $1.5 billion in annual contract value for 2026. This is not just pipeline optimism. It is actual, quantifiable monetization. You can really hear the confidence from CEO Bill McDermott here. He's out there claiming that AI is the greatest tailwind in the platform's entire history, and they're already far exceeding their initial goals. And because ServiceNow charges based on workflows and consumption rather than just human user seats, the AI automation doesn't threaten their business model at all. It actually accelerates it. As customers automate more tasks, they simply run more workflows through the ServiceNow platform. And this AI momentum is incredibly tangible. Customers spending over $1 million annually purely on Now Assist grew by over 130% year over year. On top of that, the company closed 16 massive transactions worth over $5 million in Q1. That's an 80% jump. And perhaps the ultimate sign of business durability, they have maintained a pristine 97% overall renewal rate for 6 consecutive quarters. Think about that. Their customers simply do not leave. Even if you factor in the forward guidance cuts from the Armis integration, ServiceNow's underlying financial engine is just incredibly powerful. Let's apply the Rule of 40, which is a key SaaS valuation framework that adds a company's revenue growth rate to its profit margin. Usually, a score over 40 indicates an elite, highly efficient business. Well, ServiceNow boasts a score of 54, combining their 22% reported growth and 32% operating margins. So what does all of this mean for the actual price tag of the stock? Let's check out the valuation reset. After that brutal 17% earnings crash, ServiceNow's forward revenue multiple violently compressed. It dropped from a 5-year average of 13 times all the way down to just 5.6 times. The market basically completely washed out the premium that had historically always been assigned to the stock. When you stack them up against other tech giants, this valuation paradox gets even wilder. Microsoft is growing cloud revenue at roughly 12%, but trades at a 10 times multiple. Salesforce is growing at about 8% and trades around 5 times. Meanwhile, you have ServiceNow growing subscription revenue at 19 to 22%, which is significantly faster than both of them, yet it is currently trading at a highly compressed 5.6 times multiple. How does a company growing that much faster get penalized with a multiple like that? So as an investor, you're left with a pretty stark choice here. Do you trust the bull case, meaning you believe in the 97% renewals, the very real $1.5 billion AI monetization curve, and a historically cheap 5.6 times multiple for an elite Rule of 40 software compounder? Or do you fear the bear case, believing that the decelerating forward carpo, the macro headwinds in the Middle East, and the margin drag from the Armis integration are actual signals of a structurally slower growth future? The ultimate resolution to this debate isn't just going to linger in the ether. It will likely arrive at their upcoming Financial Analyst Day in Las Vegas on May 4th, 2026. This is where management is widely expected to reveal their updated 2027 and 2028 targets. If they can conclusively prove that AI revenue will definitively stack on top of their organic growth, the market might quickly re-rate the stock. Which leaves us with this final, really provocative thought based on the data we've explored in this explainer. At this heavily discounted valuation, is ServiceNow a generational value trap that is simply succumbing to the new normal of higher rates and slower software spending? Or, with its incredible AI monetization and unyielding customer retention, is it quite literally the absolute smartest AI play on the market today?